Okay, I think we fixed that whole issue. Let's see if we can't get through the rest of this PowerPoint presentation in one more video. Promissory note is notes receivable. A promissory note is a written promise to pay on a specified amount of money, usually with interest either on demand or at a definite future date. So your promissory note would have a date, the amount, the number, the due date. So it says 90 days after date. I promise to pay to the order of, to the company, the payee, $1,000 for the value received with interest at a rate of whatever the interest rate is, payable at wherever, and signed by. Okay? Computing maturity and interest. I know you all love to compute interest. It's so much fun. Computing maturity and interest. The maturity date of a note is the day the note, principal, and interest must be repaid. On July 10th, TechCom received a $1,000 90-day note at 12% as a result of a sale to Julia Brown. So the number of days in July is 31 minus the date from the note. It was done on the 10th. So you have 21 days in July. You have 31 days in August, you have 30 days in September, and then it was paid on October 8th. Notice due and payable on October 8th, so a total of 90 days. So you're going to take your principal of the note times your annual interest rate times the time expressed for the fraction of the year equals the interest. The annual interest rate, even for maturities less than 1 year, the rate is annualized. If the note, excuse me, is expressed in days, base a year on 360 days using the banker's rule. 360 days is the banker's rule, not 365. So, you take your $1,000 note times the 12%. Okay, because that's for the 12% is for a full year, but you're not. It's only going to be 90 days, so you have to take it by divide 90 by 360 to come up with just the interest for the 90 days. Equals 1,000 times 0.12 times 0.25 or $30. Recognizing notes receivable. Notes receivable are usually recorded in single notes receivable account to simplify record keeping. The original notes are kept on file, including information on the maker, rate of interest, and due date. To illustrate the recording of the receipt of a note, we use the $1,000 90-day 12% promissory note from Julia Brown to Telcom. Telcom received the note at the time of the product sale to Julia Brown. On July 10th, we debit notes receivable for $1,000 and credit sales. Typically, when I see a notes receivable, I also see in the notes receivable description who it's to, just so we can keep track of them. And I do this a lot. We have a lot of notes receivable. So, a lot of times what they'll do is if you have an accounts receivable that may be uncollectible, what they might do is, and I see this a lot in rentals, is they get so far behind in their rent that they set up a note receivable, signing a note with interest to get caught to make payments on all of past due rent. So we'll see a lot of notes receivable then for that, and then they have to stay current with that the remainder of their rent. So you have, but I always have a name with them so that you can keep track of it. Recording an honored note. The principal and interest of a note are due on the maturity date. J. Cook has a $600 15% 60-day note receivable due to Telecom on December 4th. So we received cash of $615 because we're going to get rid of the whole $600 plus our interest revenue. So your $600 times 15 times 30 divided by 360. That's the 15, so total cash received is $615. That's how you get rid of it. If you have a dishonored note, the act of dishonoring note does not relieve a maker of the obligation to repay the principal and interest due. Telcom holds an $800 12% 60-day note to Greg Hart at maturity October 14th. Hart dishonors the note. So what happens then, because it was a receivable, now it's a note receivable, we put it right back into accounts receivable, but we're putting also in there the interest. So we just go put it right back into his subsidiary ledger for a dishonored note. So we don't write it off at that point. We move it into accounts receivable and then adjust it to our allowance account. Recording your end of period interest adjustments on December 16th. Telcom accepts a $3,000 60-day 12% note for a customer and granting an extension for a past due account. When Techcom's accounting period ends on December 31st, 15% of the interest has accrued on the note. So they're not receiving the cash, but we set up an interest receivable for it and record it as interest revenue. We're assuming that it will be an honored note. We don't know that yet, but we are assuming that. So it's going into interest receivable. So then when you collect it, you're going to reduce your interest receivable because we've already recorded that interest income. So your interest income will not be quite as high. But then you're matching periods. So recording end of period adjustments. So we had 31 days in December. We minus our 16 days of notes. We had 15 days. Then we have January 30. Number of days in January is 31. Days in February is 14. So we get to the 60 days. Recording collection at the note at maturity. We're going to debit cash for the full $60, which is your 3,000 times 12 times 60 divided by 360 equals $60. So we'll have debit our cash for the $3,060 that we're going to receive. We're going to get rid of the entire $3,000 out of note receivable. We have to get rid of the $15 of interest receivable, and the rest will go to interest revenue because we earned $45 of that in the current period, $15 in the prior period. Disposal of receivables. Companies can convert receivables to cash before they are due. They can sell them or they can pledge them. Selling of accounts receivables would mean they go to a company and they buy the receivables. They get, they get 85 cents on the dollar. So they don't get to cut all of them, but then it's the other company's responsibility of collecting the money. If you pledge your receivables, that means you get a loan on them, and then as you receive them, you pay back the loan. Global view, recognition of receivables. Both U.S. GAAP and IFRS have similar asset criteria that apply to recognition of receivables. Further, receivables are arising from revenue-generated activities are subject to broad similar criteria for U.S. GAAP and IFRS. Valuing of receivables, both U.S. GAAP and IFRS require the receivables be reported net of estimated uncollectibles. Further, both systems require that the expense for estimated uncollectibles be recorded in the same period when any revenues from those receivables are recorded. Disposition of receivables, both U.S. GAAP and IFRS apply broadly similar rules in according disposition of receivables. Accounts receivable turnover. This ratio, I know another ratio, you love ratios. This ratio provides useful information for evaluating how efficient management has been in granting credit to produce revenue. It's net sales divided by average accounts receivable net. So the receivables are net, so that's net of the allowance account. So you take your net sales divided by your average accounts receivable, and that is your turnover. That's how fast your receivables turn over. So you can see in Dell and Apple the difference. And then our favorite slide, the end of the chapter. Yay, we made it through it. Whew. Thank you. Good night.